Hello everyone and a big welcome to RJ Sanderson TV. It's November, the year is almost at a close, but there's still plenty to come on this show, and Roy Sanderson, as always, is alongside me. Roy, welcome. November, how's the last few months been for you?
Yeah, it's been good, Dave. There's a little bit of confidence out there in the market. It's been a busy time for us. July through to September's when we're doing a lot of personal tax returns, and now starting on our business tax returns, which is fantastic. And people are getting their refunds and are out there spending money, which is good.
And I think that's a bit of a spoiler alert for one of the indicators to come that absolutely supports that. That'll be all part of our economic indicators. And we've got a big show today because there's some tax news out there, Roy, that has implications for this year's return, future returns and past returns that we'll go through in detail. We've got an update on the share market, which has taken a bit of a tumble of late. We'll go through our normal economic indicators. Roy, you've got all the property news as always. And get this, not one, not two, but 5 viewer questions at the end. Plenty of feedback that we've got and plenty of questions. Always one of my favourite times of the show. But let's get into the first tax tip for the show, Roy. And it is relating to some of the news that is in the air at the moment pertaining to how social media giants are taxed.
Yes, Dave. So this is a 2.5% tax on revenue. That's turnover. And this is a shift because it's not a tax on profits. We know that the social media giants shift their profits offshore, so the tax take in Australia is quite low. So pat on the back to the government. This was actually introduced back in 2021, has been delayed, and they've now announced it's coming in and will be active from January 2026. Of course, these social media giants, they can reduce their tax if they spend money on Australian news services to purchase their news, and the streaming services need to spend 7.5% of their Australian revenue or turnover on local drama, arts, education and documentary. So I do like this tax because it's based on turnover and revenue, which means we will definitely get the tax rather than it being based on profits.
Okay, Roy, you've been strong on the proposed super plan about not taxing unrealised gains. How is this different from taxing unrealised gains when the profit hasn't potentially been established?
So when you tax an unrealised gain, Dave, you're taxing money you don't actually have in the bank account. When you're taxing turnover or revenue, you're taxing money that's hit the bank account. So they have the money, so the tax is good. If we tax profits, and I'm not suggesting we change this for anybody except the international organisations, the giants, then you're actually taxing money that's been received rather than profits, where the profits are reduced in Australia by shifting the profits offshore. So no, this is a good thing.
Another case that is before the courts at the moment is pertaining to work from home. And Roy, this one could have some pretty interesting ramifications.
Yes, it's very much watch this space. An ABC worker was forced to work from home due to COVID. He claimed a percentage of his rent for the spare room and kilometres to drive from his home office to his work office. Now, the ATO did an audit. They refused it. They refused the claim because he didn't have a business at home. He was on wages, but COVID said he was forced to work from home. He took it to the AAT. They then allowed it in full. Now, the implications are huge. The ATO have said they're taking it to the federal court. But why it's huge is because in Victoria, if the state government bring in a compulsory allow to work from home for 2 days per week, that means all of us that work from home for those 2 days potentially can claim a percentage of your mortgage interest or your rent, and also claim kilometres to drive from the home office to the work office. So watch this space. It's an interesting one.
Could be a total turnover of the entire landscape there. So, and as you mentioned, Roy, previous returns because it pertains to COVID and then potentially future. So there's a lot of ramifications. So watch that space. Roy, 19th of November as we record this, and the Christmas trees are up in the shopping centres and you can feel the festive buzz in the air, and you've got a Christmas tax tip for employers.
Yes, I just wanted to make sure employers start planning. Vouchers up to $299. Now, I know from experience it's hard to buy a voucher for $299. They come in $50 increments. Don't go to $300 because that loses the deduction in full. Go to $250 if you need to. It's tax-free to the worker. There's no fringe benefits tax. The boss gets to claim the tax deduction for the purchase of the voucher, and they pay no super and no work cover. It's actually a win-win situation. Start buying your vouchers now.
Tax tips report there, it says at the bottom, for some secret tax tips. You've caught my attention there.
Yeah, if you want a report, we've got a list of about 50 tax tips that some are obvious to us because we're in the industry, but some you might not know about. Just send an email through to info@rjsanderson.com.au and we'll send you at no charge, no obligation, a copy of our free tax tips report.
Claiming kilometres and claiming travel expenses, Roy, for your car used in work has undergone some change since we've seen the electric vehicle proliferation.
Yeah, I just wanted to reinforce there's two options. You pick one or the other. Up to 5,000 kilometres, you can use the cents per kilometre method, which is quite easy. Second option is that you have a logbook for 3 consecutive months. That works out the percentage. You then claim a percentage of your fuel, rego, insurance, repairs, everything to do with the car based on that percentage. But the common question we've had recently is, but I have an electric car, how do I claim fuel because there is no fuel? Well, you get to claim 4.2 cents per kilometre you have travelled for the year based on charging at home. So just keep that in mind.
Now, another really interesting one is this one coming up, Roy. It pertains to GoFundMe pages because many people know that you can claim donations as a tax deduction, and many people, I think, would assume that if you make a contribution to a GoFundMe page, you can claim that as a tax deduction. What's the answer to that?
Well, most GoFundMe pages are exceptional causes, but unfortunately, unless they're a registered charity, it's not a tax deduction. And it's probably the most common thing we have to say no to in the many tens of thousands of tax returns we've done this year already. But if it was Make-A-Wish Foundation or a registered charity of any sort that has set up a GoFundMe page, then it can be a tax deduction. So certainly check the GoFundMe page out on who is running it.
And then also you've got down there school building funds. That's a popular one at this time of the year as people renew their primary school or secondary school enrolments.
It's probably the one that gets left out, Dave, the most, and that is because you pay the kids' school fees and you just pay it and don't think about it. But when you come and talk to the accountant, he says if you go through your school invoice, if there's a school building fund contribution and a dollar figure next to it, and it will confirm that it's tax deductible, then you make sure you put it on your tax return.
Yeah, and then they can sometimes be some big asks.
There are a few $100s, yes.
Yeah, so make sure you claim that one. There's also a bit of news around becoming a property investor and some more hurdles. Yes,
this is Victoria. This is effective from the 25th of November, and I don't know if these are well known, but they have certainly come in. Owners, you just can't give a tenant notice to vacate. You have to now have a valid reason, and that vacate notice or any rent increase, it was 60 days notice, it's now 90 days notice. And when you do a rent increase, you've now got to have clear evidence and market data to back up how much extra you're asking for. So I just think some of these changes, what I'm worried about is we do have a property crisis in Australia, but also in Victoria. And at the moment in Victoria, we seem to be hammering landlords, and I would have thought the way to fix a property crisis is to create more properties, and you do that by encouraging landlords to invest in property, and that is just not happening at the moment in the marketplace.
And we're going to see more on that in some subsequent slides. We love a crazy deduction, or the attempt at a crazy deduction, Roy. I'm going to read you this one. A sole parent with 2 children. Partner lives overseas. She has no direct family. She's a real estate agent, has to attend a compulsory function, and she wants to claim those deductions on screen. What's the answer, Roy? What did the ATO say to this one?
Evening gown? No. Makeup and hair? No. Kilometres from home to the venue? No. Child minding fees for the evening? No. Sorry, Dave, but that's a no across everything. The evening gown is the interesting one. It's considered by the tax office as being normal clothing, even though it's specific to the event, and she may have hired that. You still can't claim the evening gown, I'm afraid.
Even if it's compulsory? So even if this event is compulsory and comes with an obscure dress code?
Compulsory, even if it's in the employment agreement, irrelevant. They're not tax deductible.
Okay, so just to put you on the spot here, I think we've talked about book week costumes in the past and those being claimable?
Yes. So a costume is a costume. A clown or an entertainer can claim his clown costume. A teacher can claim book week costumes because they're costumes. A gown, let's not call that an evening gown a costume. It's not.
Okay, so there's a tip for employers. If you're having an evening compulsory function, make it a costume party so that the employees can claim the tax deduction. We need to put this warning up, Roy, to make sure that everyone knows that this is general advice that follows.
We're about to talk about the stock market, and I don't want people going out and going, well, Roy said on RJS TV I should buy this or that. Any comments from here on in are just recommend or suggestions. You should seek out advice from a financial planner or a wealth manager. We have them available at RJS, but certainly don't just go out and do your own thing.
rjsanderson.com.au for more information on that. Let's have a look at the ASX. It has taken a tumble over the last month, Roy.
Look at this, Dave. We had 8 to 9% returns for the year. They have just been cut in half in less than a month. So I just wonder if now is the time to look at buying into the share market. And if you were sitting on the fence with some cash, these drops are quite significant. And I would be surprised if they go much further, but you never know. But I would think now might be certainly the time.
Yeah, so some information that's come to hand on global markets, Roy. The public and private sectors obviously are waiting advice on whether the Federal Reserve will lower interest rates in the US. The probability of a rate cut was 90%. That's changed now a 50-50, that coming up in the next week. And then also the biggest company in the world, Nvidia, is to release its earnings report on Thursday. And Roy, I just want to take you through some of the numbers on Nvidia because it might be a company that you've actually, that some people are hearing for the first time. It is a global giant of epic proportion. And to give a clear picture on the scale of this, Nvidia's market cap is greater than the combined market capitalisation of every major publicly traded bank in the United States and Canada.
What do they do, Dave?
They make graphics processing units for computers. They run in all computers, and they are integral in building AI at the moment. So a lot of the stock market has been geared towards AI. As you can imagine, a lot of people thinking that that's the future of the world, that's the future of technology, etc. So they are integral in that process. So I think there used to be an expression in Australia that if America sneezes, Australia catches a cold. Well, I think you can pretty much apply that to Nvidia. I mean, if Nvidia murmurs, that it spooks the entire world at the moment. So people sweating the earnings report of Nvidia that comes out on Thursday. It is Wednesday as we record this show.
Yes, and I thought I would highlight a couple of Australian stocks along with that one you've just mentioned, which is on the US stock exchange, the NASDAQ, I think, if I recall.
Correct.
If you have a look at this slide, I've just highlighted some of the major decreases in the last month. Wesfarmers, who own the Bunnings brand, along with many others, that drop is significant. CBA, who make up, these are large companies and make up a fair slice of the Australian Stock Exchange 200. Huge drop by the CPA. Again, if you're sitting on the fence, reach out to our wealth management team. The phone number is there if you want to make an appointment, or go to the website at rjsanderson.com.au and get some specific advice, because now looks like a great time to put some money into the stock market.
And maybe people are ready to do that, Roy, because this next slide suggests that things are looking up for consumers. The Consumer Confidence Index is up into positive territory above the 100 marker. It's the highest since December 2021.
This is extraordinary, Dave. We didn't predict this. We've had a slide from August through to October. This is a great jump. I did question the day that it was done and whether it was on the Melbourne Cup day and everybody was counting their winnings, but that's not the case. But I thought that might be the reason.
I think one thing that they did allude to in the report, Roy, is that this number was particularly influenced by people without a mortgage. So Potentially, if you imagine how they collect this data, there's a random assortment of people. If there's more people without a mortgage than with a mortgage, it could skew the could skew the marker disproportionately. But certainly, that indicator suggests that the people are looking forward to Christmas, less restrained budgets heading into Christmas, and their prospect for future economic growth is higher than it was in the previous month. And just to give some perspective on how high that marker is historically, let's have a look at the last 5 years of the consumer confidence graph. You can see there that, as I said, the highest reading since December 2021, and also a very significant sort of marker in terms of the last, quite significantly higher than anything we've seen in those years as well. So
it's great, Dave. It's just great that consumer confidence has picked up so much. I'm over the moon.
Despite these two next indicators, Roy, which shows, firstly, that unemployment is just slightly increasing.
Yeah, I thought I'd share this because this is a concern to the Reserve Bank. These figures come out every month and they have a fair impact on what the Reserve Bank do in relation to interest rates. So unemployment has gone up, is trending up. And we look at the inflation rate and we find that the inflation rate is also trending up. I've just circled that on the left-hand side. Overall, it's not in a bad position, but these are the two factors that the Reserve Bank are looking at and being very concerned about whether they should decrease interest rates or put them on hold. And I think every major bank at the moment is expecting there will be no rate reduction, and potentially in 2026, every bank has suggested there'll be 2 rate cuts and small rate cuts. So the economic indicators will drive it. Any forecasts are just estimates at this point in time.
I think, Roy, I'm going to put a prediction on the show here. I don't think there'll be a rate cut in 2026. I think that number is actually, the CPI number is quite concerning, along with higher unemployment, and then also along with that consumer confidence number. If people are out there spending, particularly if it's a big Christmas spend, I don't think there'll be a rate cut in 2026, because I think that people have evidently are feeling more comfortable at the current time, and I think governments have learned their lesson. That inflationary period was a tough period for their constituents. They won't want to go through that again. So there'll be a lot of pressure on the Reserve Bank coming from the government to make sure that, with the blunt instruments available to them, they manage inflation. So my prediction is no rate cut in 2026.
Well, put that into the time box. I actually would love, Dave, for the Reserve Bank to come out and the government and say that interest rates will be fixed for the next 6 months, so that the business community and households community, those with loans, have absolute certainty what their rate will be. I'd love to have that. This whole thing about a monthly meeting and rates might go up or might go down, I think is not good for certainty in the economy.
A bit of a drama, isn't it? A rolling drama around the monthly meeting. Are we going to? Are we not going to? I agree with you. Trying to come up with some certainty around that makes more sense rather than just dragging that process out every month. Let's turn our attention to property, Roy, and the first one talks to the value of houses over the last 12 months.
Yes, I just wanted to show where property is going up. Now, look at Darwin. An extraordinary rise of over 15%. Lock that in your memory for a few moments, because we'll come back and mention Darwin, and look at Melbourne, where the property increases a staggering 3%. So, and I'll just mention Hobart. Now, Hobart's interesting because Hobart is potentially about to have an AFL football stadium built, and I think if that happens, the Hobart property market will jump up significantly and very quickly, because people want to buy homes for the purpose of Airbnb, somewhere to stay. There will be more demand because they're going to need infrastructure, a lot more people living around the Hobart region. So watch this space maybe next year, when we know for certain, if there is an AFL stadium, what the Hobart property market is doing.
Listings also is another important number, Roy, because obviously if the number of listings decreases, there's less supply.
This is extraordinary to think that compared to this time last year, we are 14% less, and that's a big number. That's up around 18,000 homes less on the market. And compared to just the 5-year average, we're 18% down. So the reason property prices are going up is not necessarily demand, but it is probably because demand is outstripping supply. The supply is what has dropped. We don't have as many properties on the market.
Yeah, absolutely. It's almost by that graph, it's almost entirely a supply thing. So if we have a look at the comparison to last year, you can see the numbers as per that graph.
So the prior slide, Dave, was actually all of Australia. This breaks it down per area. Now, the number of listings. Have a look at Darwin, which I mentioned a moment ago. They have 44% less properties for sale than they did 12 months ago. That's the reason Darwin has gone through the roof. And you look at every single capital city, every single regional area have less properties on the market than they did 12 months ago.
Yeah, just note with that graph that the bar can go to the right as well as to the left.
Yeah.
Not one of them is going to the right. It is all negative supply. So it's quite a staggering graph, Roy, because I really want to put this out there is that we talk about a housing crisis, and there is far fewer houses available or properties available than there was this time last year. Now, that's not to say that there's not more rentals available, and you know you can debate that, but yeah, that doesn't look like progress on the housing crisis, which has been at the forefront of government policy and the Parliament for the last 2 years. So quite staggering. Let's have a look at rental growth anyway and move into that space. And what does this indicate? Because there's quite an interesting change of direction in that curve towards the end there.
With house prices going up, with less supply, I would have expected rents will go up. They have gone up. Interestingly, Melbourne is increasing at the lowest of any of the capital cities, at just under 2%, probably because Victoria as a whole are not encouraging property investors like the rest of the states. They're being hit quite hard, which I've spoken about over and over. I suspect that when we get together next year, we'll be looking at this graph and that 4% will be a little bit higher. So I think there's pressure on rents to continue to increase.
Right, that is a pretty comprehensive summary, Roy, of economic conditions, indicators, property, the stock market, and some tax news. Now let's get to some of the hard-hitting questions from our viewers. And the first one that kicks off is from a nurse. I'm a nurse. I have been told it is compulsory to get a flu shot. Can I claim the flu shot?
You so would think the answer is yes.
Got to be yes.
Yeah, but it's no. The flu shot, unfortunately, by the tax office is classed as a medical item and therefore not tax deductible, even if it's compulsory and even if it's logical for a nurse. And I might just say, I appreciate the questions that come in from this show. It's awesome. It allows us to put these questions to air to answer them. But unfortunately, nurses listening, the flu shot, even if it's compulsory, is not a tax deduction.
Is that a blanket rule on shots in general, or is it just the flu shot?
No, it's shots in general, COVID shots, etc. They're not tax deductible either, so they're classed as medical.
There you go. The next one is a bit of a roundabout one. Ben's a carpenter. His parents paid $100 for a leather-bound diary as a gift. He uses it every day for work. Can he claim the cost of the diary?
Well, the answer, unfortunately, is no. Ben didn't buy the diary. It was given to him as a gift, so he can't claim it.
Can his parents claim the cost of the diary?
No, because they don't use the diary for work. So they paid for it, but it's not their work item, so they can't claim it either.
And does it change if Ben gives, or if his parents give him the receipt?
A good question, Ben. But the reality is you haven't paid for it, so therefore it's not a tax deduction. If you reimburse your parents the $100, then you can claim it. But the reality is if you haven't paid for it, just having the receipt is not enough. You've got to, under tax office regulations, you've got to have paid for the item.
Okay, well, there you go.
Sorry, Ben.
We've had 2 no's now, so you really are the fun police today, Roy. What about interest on a tax debt? I went on a payment plan with the ATO. I was at a tax bill last year. The ATO charged interest at 10.6%, which is just over $500. Not a very attractive interest rate, by the way, Roy. Can I claim the interest on unpaid tax debts as a tax deduction?
Well, if it was interest paid up to the 30th of June 2025, so that's last year's tax return, the answer is yes. But from the 1st of July, the tax office changed the regulation. So from the 1st of July, that interest is no longer a tax deduction. Absolute incentive to go talk to a bank or talk to an accountant about other options to pay off a tax debt, because the interest rate charged by the tax office is the highest in the land. We can certainly get you cheaper than that elsewhere.
Yeah, and make sure you're managing your tax throughout the year as well. I think pay-as-you-go instalments, if you need them, there are other options available than landing a huge tax debt. Okay, this one we've had a similar sort of question earlier in the piece. I attended a compulsory work-related gala evening and hired a tuxedo. We know an evening gown's not claimable, Roy, but is a tuxedo claimable?
So what do you think, Dave? It's got to be no.
It's not a costume.
It's not a costume. It's a tuxedo. Tax office believe a tuxedo is classed as normal clothing, although not many of us wear a tuxedo for anything but a work function. The reality is it's not a tax deduction. Sorry.
What's that? 3 no's and a yes so far. Home office is the next one. Let's round out the viewer questions with this one. I've set up a home office as I work from home some days per week. I'm on wages and don't have a business. I purchased a painting for the home office which costs $2,000. Can I claim the painting as a tax deduction?
Well, the answer is yes, it's the home office, but bear in mind, because it's over $300 and you're on wages, we will depreciate that over time because the cost was over $300. So it's yes, but it's over time. So we finally get a yes, Dave.
So if it's a painting of note, Roy, and you need to depreciate it over time, is there a set period of time, or does it depend if it's a Monet? It might be a timeless piece. No, could be a useful life of 200 years.
The painting or the picture will have a set rate that we claim. It doesn't matter whether it's 2,000 or more. But if the question, additional question there was, what if is it different if I have a business? And the answer there is yes, because a business that's not on wages, they have the ability to write off up to $20,000. So in the business office, if you were running a business from home, that $2,000 is tax deductible in one go because it's under $20,000.
How many paintings can you have in an office?
No, it comes down to reality, Dave. It's not about what the tax office will allow. It's about how many walls have you got and what have you physically got in the office.
At what point does it become a gallery? Hey, let's finish off with Roy's Rage, the final Roy's Rage of the year. Unfortunately, we are heading to the industry that I know that you've got some real issues with, and it's pertaining to holiday homes.
Now, I might point out, this does annoy me, which is why I've put it in my Roy's Rage, but this is not law yet. This is a guidance or a proposal put out by the tax office for consultation, and we have until 30th of January to give the tax office feedback. But it is proposed that this will commence from the 1st of July. And what they are looking to change is that if you are renting your property out on short stay accommodation, you need to be able to show that the home or that property is mainly used to produce income and available in peak periods. We don't have a definition of mainly. We don't know if it's 50% or more. We don't have a definition of peak periods. Is it Easter or Christmas? But is it winter on the slopes, or is it summer down at Mornington Peninsula? So we need some definitions around those. If this becomes law, then anybody who doesn't tick the box mainly and available in peak periods, then you will not be permitted to claim any portion of your holding costs, which are interest on your mortgage or a percentage of your interest on mortgage, council rates and land tax. So those 3 items are 0 claims as a tax deduction, where today they would potentially be claimed based on how many days it was rented compared to how many days it wasn't rented or used by the family as the holiday home.
So your rage here is about the ambiguity of that, or what do you disagree with in that?
I believe that if you rent your property out on short stay, based on the number of days that it is available for rent, you should be able to claim a percentage of those holding costs. And I think this change is just about trying to save some dollars for the government. It's not logical. And please, will you stop kicking property investors? We need to fix a housing crisis. This is just another one to kick property investors.
Wow. Yep, that's a good one to leave us with, Roy. Plenty of meat on the bone. Roy, this is it for 2025, our final show of the year. It's been a privilege as always. our 6th year. Can you believe that, Roy, that we've been doing this? We kicked off in the depths of COVID. We wanted to bring some information to the living rooms and lounge rooms and home offices of people stuck at home. And here we are in 2025 still going. The viewers at home want to know, is this it? Are we done?
Well, we did ask for feedback last month, and we do know that across our social media channels, our website and YouTube, we get about 35,000 people looking at RJS TV, which we're pretty happy with. And we have signed on for another year next year. So, Dave, we are back in 2026.
Back for a 7th season. That's fantastic news. And a testament to all of you who join us each month. Thank you, and a big thanks to everyone who's watched, listened, contributed to the program. A big thanks to you, Roy. Your support of the community and bringing tax advice to people who perhaps haven't considered getting formal tax advice, perhaps haven't investigated getting formal tax advice, I think is extremely important. So congratulations to you, Roy, and to RJ Sanderson for investing in this community arm of the business. And a big thanks to everyone at RJ Sanderson. If you do want more information, as always, please visit the website rjsanderson.com.au. And you heard it here first. We'll see you in 2026.